Welcome to the deep dive. Today we're sinking our teeth into Sheela Foam Ltd, or SFL. You probably know them better for Sleepwell, and now Kurlon too.
Exactly. We have got their latest financials, H1 FY26, so up to September 30th, 2025. And look, our mission today is pretty straightforward. This is the first big look we get after the Kurlon merger. Is it working? Are we seeing real volume, real margin efficiency?
And the initial numbers, well, they suggest a pretty strong yes. Consolidated revenue is up about 5% year on year. Okay, respectable.
But hold on, that 5% isn't the main event?
Not at all.
The real kicker is the profit from actually running the business.
Yeah.
Consolidated core EBITDA, I mean, it didn't just grow, it absolutely soared, up 31%.
Wow, 31%.
Yeah, and when you take 5% revenue growth and somehow squeeze out 31% more operating profit, that screams operational leverage. It's probably the clearest sign yet that the Kurlon integration is delivering scale and efficiency almost immediately.
Okay, let's unpack that. Because, 31% EBITDA growth doesn't just materialize out of thin air. How do they pull it off?
Well, first off, they're moving a lot of product, mattress volume specifically, up 11% in H1 compared to last year.
11% volume growth. And to do that, you need places to sell it.
Precisely. They've been busy on the ground, added 420 net new showrooms in just 6 months. That pushes their total retail touch points, places people can actually buy, to over 11,300.
That's a massive footprint.
It has to be to support that kind of volume push.
Okay, network's growing. But let's go back to that core profit jump. That core EBITDA margin, it expanded by 210 basis points. That's 2.1 percentage points for everyone listening. Now at 10.4%. How do you grow margins like that while growing volume 11%? Usually you sacrifice one for the other.
Yeah, it's a delicate dance, isn't it? It seems to be a mix of product strategy and sheer efficiency. Take their foam segment, the raw material side. Volume there grew 8%, okay? But revenue only grew 3%.
Interesting gap.
Right. What that suggests is SFL made a strategic call. Prices for key inputs like TDI and polyol came down.
Yeah.
And they seem to have passed most of that savings straight to the customer.
Okay, so instead of just boosting their own margins with cheaper materials, they cut prices or held them steady to grab market share.
Looks like it. It's a competitive move. Prioritize volume, build loyalty, maybe squeeze out smaller players.
But isn't that risky? I mean, what happens to that nice 10.4% margin if those raw material costs shoot back up next quarter?
That's the gamble, absolutely. They're betting that the scale, the sheer volume, and the efficiencies they get from integrating Kurlon's manufacturing will be enough to absorb future price shocks. Make the product cheaper now, lock in the customer, and hope the internal machine is efficient enough to handle whatever comes next.
It's definitely a long-term play. And speaking of volume drivers, where people are buying is fascinating. It looks like they've got this, two-pronged attack going on.
Oh, it's really interesting. You've got the high-end digital push and the mass-market physical push happening at the same time, and both are firing on all cylinders.
The e-commerce numbers are just wild. Sales volume on their own website, brand.com, up 135% year over year in the first half.
135%.
Yeah. And even on third-party sites like marketplaces, volume jumped 58%.
That's not just growth. That's, like you said, conquering the digital space. They're clearly capturing that premium, convenience-focused buyer online.
But you mentioned it's only half the story. What about the physical mass market side?
Right. While digital boons, they haven't forgotten their mattress for every Indian goal. They specifically pushed their budget brands, Terang and Aram, and the results. Volume up 58%. But get this. The value of those sales was up 109%.
Whoa. Okay, so they're not just selling more cheap mattresses, they're selling better, slightly more expensive mattresses within that budget category, moving people up the ladder even at the entry level.
Exactly. It's a full spectrum approach. Capture the premium online, capture and upsell the budget buyer offline.
Smart.
And it's not just mattresses showing growth. If you look at the standalone figures for India, total mattress volume up 11%, sure. But technical foam, that stuff for cars, industry also up 11%, and comfort foam up 8%. It's pretty broad-based.
Okay, let's switch gears a bit. The corporate side, the Kurlon merger, biggest news of the year for SFL. How's that actually showing up in the accounting?
Well, it's officially done. The NCLT, the court, basically, gave the final nod on September 17th, 2025. Now, the key thing for you, the listener, is how they're accounting for it. They're using something called the pooling of interest method.
Pooling of interest. Oh, okay, what does that actually mean when I look at these numbers?
Think of it like this. The accounts are written as if the merger happened right at the start of the comparison period, so April 1st to 2024.
Ah, okay. retroactive.
Exactly.
Yeah.
So when we talk about that fantastic 31% core EBITDA growth, it's comparing the combined SFL Curlon performance this year to the combined SFL Curlon performance last year, even though the merger wasn't legally done back then. It makes the comparison much more meaningful, apples to apples in terms of operations.
That context is absolutely crucial. Got it. And alongside this integration, there were some leadership shifts, too.
Yeah, some key redesignations. Rahul Gautam is now chairman and managing director, suggesting, very hands-on strategic oversight. And Tushar Gautam is elevated to vice chairman and joint MD. It looks like a structure designed to really drive that post-merger synergy.
Okay, now we need to tackle the elephant in the room, profit after tax paid. You see that core EBITDA soaring 31%, but then the bottom line consolidated paid for H1 is just 17 crore rupees. And that's down 72% year over year. If you only saw that number, you'd panic.
You absolutely would. And this is a textbook case of why you can't just look at Pate in isolation, especially during big changes like a merger. That scary 72% drop. It's mostly an accounting echo from last year.
How so?
H1 last year, FY25, included a big one-off exceptional gain, about 31 crore rupees from an insurance payout related to a fire in a previous year.
Ah, so last year's profit was artificially boosted by money that had nothing to do with selling mattresses or foam.
Precisely. A non-operating windfall. Take that out, and the picture changes dramatically. Plus, this year, H1 FY26 had its own exceptional item, but it was a loss about 7.8 crore rupees from selling some land and buildings they didn't need anymore.
So last year's base was high due to a one-off gain. This year's Paytee was hit by a one-off loss. The underlying business didn't suddenly become 72% less profitable.
Exactly. The core EBITDA figure, that 31% growth, that's your clean look at how the actual business is performing, stripping out these noisy one-offs.
Excellent clarification. Okay, let's look beyond India for a moment. SFL has international operations. How are those doing?
It's a story of stability mixed with some pretty impressive efficiency gains. Take Australia Joyce Foam. Revenue in Q2 was basically flat year on year, around 105 crore rupees. Okay, fine. But their EBITDA margin, it leaped from 2.1% to 9.5%.
Wow, from 2% to almost 10% margin on flat revenue. That suggests some serious cost-cutting or operational changes down under.
It really does. Something significant happened there operationally. Then Spain, Interplasp, steady as she goes. Revenue grew nicely, from 86 crore to 93 crore, and they maintained a very healthy EBITDA margin around 10.9%.
Solid.
And finally, their IT arm, StayQO. Revenue up from 12 crore to 16 crore. The margin dipped a bit, from nearly 32% down to 26.5%. Still very profitable, but a slight decrease worth noting.
Okay, so internationally, mostly stable with a standout margin improvement in Australia. Let's bring it back to the consolidated picture of financial health. How are the key ratios looking?
Overall, pretty stable, maybe even slightly better on leverage. The debt-to-equity ratio improved a bit, down from 0.48 to 0.41, so less debt relative to equity, which is generally good.
Okay, positive sign.
However, we do need to flag the debt coverage ratios.
All right, what are those telling us, especially given that strong EBITDA growth we talked about?
So the main ones, interest service coverage ratio, ISCR, and debt service coverage ratio, DSCR, both went down. ISCR fell from 1.86 to 1.52. DSCR dropped more sharply from 0.33 to 0.23.
Okay, translate that for us. Lower coverage means.
It means that even though their operating profit, EBITDA, is way up, a larger chunk of that profit is being eaten up by interest payments and mandatory debt repayments right now.
Ah, I see. So the profit engine is running stronger, but the cost of financing everything, including that Curlon deal, presumably is taking a bigger bite out of the cash generated before taxes.
That's exactly it. The debt level relative to equity is better, but the cost of servicing the existing debt seems to be weighing a bit heavier on the immediate profits. It's not alarming yet, perhaps, but it's definitely something to keep an eye on. You don't want financing costs to start canceling out those hard-won operational gains.
Makes sense. Okay, finally, let's look beyond the numbers. SFL also talked about their ESG commitments, environment, social governance. They gave some pretty concrete goals.
They did, and it's good to see specific targets, not just vague statements. They're looking out to FY30. On the environment front, boost solar energy use from 25% now to 37%. Cut water use intensity, this water per ton of product, from 0.85 down to 0.76 KLMT. And manage waste better, aiming to cut disposal costs by basically monetizing more waste. targeting a reduction down to 13% cost for 14.5% now.
Okay, measurable environmental targets. What about the S&G social and governance?
On the social side, clear goals too.
Yeah.
Increase gender diversity in the workforce from 6% to 10% by FY30,
Right.
and increase the number of employees with disabilities from 7 now to 11 by FY30. On safety, which falls under governance, they're aiming to move from internal audits now to getting the full ISO 45001 certification by FY30.
So these aren't just aspirations, they're actual trackable metrics. It shows a commitment beyond just the next quarter's profits.
Right. It paints a picture of a company thinking about long-term sustainability.
So wrapping this up, the story from this deep dive seems pretty clear. The Kurlon merger is paying off operationally. They're driving serious volume through that dual strategy, high growth, digital, strong budget, physical presence. And crucially, that scale is translating into really strong core margin expansion. Operationally, they seem to be firing on all cylinders.
The execution is definitely impressive, no doubt about it. But, it feels like it rests on this delicate balance. We saw how much of the profit lift came from internal efficiency and scale, while they were benefiting from, or at least passing on, lower raw material costs. TDI, polyol, those prices swing wildly. So it leaves you with this lingering question.
Yeah.
Going forward, how much can SFL rely on just being operationally tighter and tighter to keep that 10% plus core EBITDA margin going?
Yeah.
Versus how much are they going to be dependent on raw material prices staying favorable or at least stable? What new tricks, what new strategies might they need in the second half of the year to protect those margins if commodity markets turn against them? That feels like the real stress test coming up.